Meet Alex. Alex follows a strict financial code. If you can't pay for it in cash today, you don't buy it. They have spent years avoiding every form of debt, from credit cards to personal loans, believing this makes them the perfect candidate for a bank's trust. When Alex decides to buy a home, they walk into a bank and slide a thick stack of cash across the desk for a down payment, expecting the red carpet treatment. Instead, the loan officer runs a report and delivers an immediate rejection. A hidden calculation has scanned Alex's life and returned a failing, low three-digit number. The consequences follow Alex everywhere. When they try to finance a simple television, the system approves them, but only at a 27% interest rate that would effectively double the price of the TV over time. By following the rules of traditional financial responsibility, Alex has inadvertently signaled to the system that they are a high-risk gamble. This three-digit number is the gatekeeper for your major life purchases, operating on a specific logic that has very little to do with how much money you actually have in your pocket. Once you enter the world of credit, your cash reserves become irrelevant. The algorithm is blind to your savings. It only measures your behavior when you are handling borrowed money. This chart reveals how the algorithm weighs your life. The largest segment, at 35%, is your payment history. This is a test of predictability. Lenders want to see a consistent, rhythmic record of you meeting obligations. Each on-time payment serves as a data point that confirms you are a reliable investment. However, the system is designed with a hair trigger. A single missed deadline creates a jagged break in that timeline, causing your score to drop instantly and significantly. From the perspective of a lender, your historical record is the only evidence they have to estimate your future profitability. The second major factor is credit utilization. This is the ratio between your total credit limits and the amount you actually use. This ratio measures stability. Maxing out your cards suggests financial strain. Conversely, having access to thousands of dollars in credit but only using a tiny fraction suggests you are in total control of your finances. Then there is credit age. The algorithm prioritizes experience. It favors accounts that have been open and active for decades, viewing long-standing relationships as proof of maturity. This explains Alex's failure in Act 1. By avoiding debt entirely, Alex provided the system with no data points to analyze. To a machine that only understands debt, a person with no history is indistinguishable from a person with a bad history. Without data, the algorithm defaults to high risk. Avoiding the credit system doesn't protect you. It leaves you invisible to the institutions that determine the cost of your future. Once you understand these mechanics, you can stop being a passive subject of the algorithm and start managing its inputs. One simple strategy is to keep your oldest accounts open forever. Even if you don't use the card, that account's history continues to anchor your credit age, boosting your score year after year. Next, you can manufacture a perfect payment history. By putting a small, recurring expense, like a phone bill, on a credit card and paying it off immediately, you create a flawless data stream of on-time payments. Because the purchase is small, your credit utilization remains near zero. You are satisfying two of the algorithm's biggest requirements simultaneously. Alex can now walk into a bank with a high-scoring profile. They are generating the exact data the machine wants to see, without ever actually carrying a balance or paying interest. The credit score is a system of mechanical rules. By managing those rules effectively, you ensure the algorithm works in your favor to provide the lowest possible rates when you need them most.